If you keep jumping into choppy sideways markets, you're basically giving away half of your potential profits without even realizing it. That can turn a good strategy into a losing one fast. That setup I'm about to show you stops that. That's simple. It uses free indicators, a clear risk plan, and rules that make sure you don't get stuck in sideways markets. So, first of all, we'll start with two-pole oscillator. It smooths the price so you can see if the market is strong or weak and show momentum, so you know if a move is real or just random noise. But here's the problem, like most indicators, it can give a lot of false signals, especially in sideways markets. Look at the Bitcoin chart here. The price is almost flat, yet the oscillator is giving buy and sell dots all over the place. If you follow every signal here, you take losses. Some might look tempting, but the market isn't really moving enough to support those trades. This is exactly why we need the next step. Before we dive into example, let's add the two-pole oscillator in TradingView. You'll see two main parts. First, an oscillator below the chart showing momentum and strength. Second, colored dots on price chart itself. These dots show trade ideas, but you can't just follow them blindly. You have to check the trend and strength first. So, let's do a few adjustments for the indicator settings. Make it more usable by going into settings and change the filter length to 21. This reduces some noise and make real signals easier to spot, but this is just step 1. We're not done yet. Next, we need a way to see the real trend and ignore fake signals in sideways markets. That's where trend indicator A-V2 comes in. It sits right on the chart and a smooth trend using Heikin-Ashi candles and moving averages. It doesn't predict the market, it just shows trend direction clearly. Most people make this mistake. The default length is too short. That makes the indicator react too fast, flipping with every small move instead of showing the dominant trend. To fix it, go into its settings, change the moving average type to simple, then change the period to 300. Now the Alma shift, set it to 1. And Alma deviation should be set to 14. Then set the ribbon colors to green, red, and white respectively. Simple, easy to read, no confusion. Now let's slow down and make sense of it. Green ribbon means the market is bullish. The trend is up. So if price is above green, only look for buy signals. Ignore any sell signals. Red ribbon means bearish, the trend is down. Price below it, only look for sell signals. Anything else, stay out, flat. Now the key part, trade confirmation. Look at the Bitcoin chart. The ribbon is red, price is below it. So ignore any buy signals. What about sell signals? In choppy market, the two-pole oscillator confirms a strength. Its levels 0 +1 and -1 show how strong the signal is. In a downtrend, we only take sell signals clearly above +1. Signals too close to +1, skip them. Only confirmed signals get executed. This is what separates a smart trade from a guess. Here's an example. This candle is your trigger to sell. Trend rule, check. The ribbon is red and price is below it. A string rule, check. The oscillator dot is above +1. Everything aligns. Set the stop loss just above the recent swing high or the red ribbon, which is safer. Target 1 to 2 risk to reward ratio. Simple. Following these steps, avoid the traps that destroy traders and sideways markets. Now let's go through more examples. On the chart, here there's a buy signal, but the trend is down, so ignore it. Even though the oscillator gives a dot, the ribbon shows a downtrend. If you take this trade, it would likely fail. Ignoring it saves you from a loss. Next, sell signal comes in and line up with the trend, but check the strength. The oscillator is below +1, so skip it. Even though the trend is right, the market isn't strong enough. That little dot might look fine at first glance, but taking a weak signal increases your risk of being stopped out. Another sell signal appears. Trend is a sell down. Oscillator dot above +1. Confirm. All conditions line up. Execute it with the same risk plan. You know exactly where to place your stop loss and target. Step-by-step rules remove guesswork and reduce stress. Then another buy signal pops up, counter trend. Ignore it. Even if it looks attractive, the trend is your guide. Ignoring counter trend signals, avoid trades that feel good in the moment but actually go against the dominant market direction. Over time, following these simple checks keeps your trades consistent and profitable. Finally, there's another simple strategy that works alongside this one. You can combine it with any setup. I'll link it as a recommended video at the end so you can see it applied step by step in real market conditions. This is a nice way to continue learning and see the rules in action without adding extra complexity to this strategy. Happy trading!